The United States for decades has spent more money than it takes in. This pattern of spending beyond its means has been a consistent feature of the federal budget, driven by various factors including military expenditures, social programs, and economic stimulus measures. This ongoing gap between spending and revenue creates a budget deficit. Each year the government must find ways to cover this shortfall, which often means borrowing more money. The deficit is essentially the difference between what the government earns in taxes and other revenues, and what it spends on public services and programs. To cover this deficit, the government issues debt securities, essentially IOUs, to domestic and international investors. These debt instruments are a promise that the government will repay the borrowed funds with interest at a future date. This process allows the government to continue funding its operations despite the shortfall in revenue. These securities promise to pay back the borrowed amount plus interest. The interest rates on these securities can vary, but they are generally considered a safe investment due to the backing of the U.S. government. Investors, both domestic and international, view these securities as a reliable way to earn a return on their investment. Over time, these accumulated borrowings have grown into a massive national debt. The national debt is the total amount of money that the government owes to its creditors, and it has been increasing steadily over the years. This growing debt is a result of continuous borrowing to cover budget deficits. This debt is primarily held in the form of Treasury securities, which are considered among the safest investments globally due to the stability and economic power of the United States. The U.S. government's ability to meet its debt obligations is supported by its strong economy and the trust that investors have in its financial system. The sheer size of the U.S. economy and its stable political system make U.S. Treasury securities an attractive investment for countries seeking a safe haven for their surplus funds. Many foreign governments and international investors purchase these securities as a way to diversify their portfolios and protect their assets. However, the growing national debt has raised concerns about the long-term fiscal health of the United States. Economists and policymakers worry that if the debt continues to grow unchecked, it could lead to significant economic challenges in the future. There are worries about the potential for higher interest rates and inflation if the debt continues to grow unchecked. Higher interest rates could increase the cost of borrowing for the government, while inflation could erode the value of money, making it more difficult for the government to manage its debt. This situation has led to calls for fiscal responsibility and a reduction in government spending. Many believe that addressing the budget deficit and reducing the national debt are crucial steps to ensure the long-term economic stability and prosperity of the United States. For years, China has been a major buyer of U.S. Treasury bonds, steadily increasing its holdings and becoming one of the largest foreign creditors to the United States. This strategic move has significant implications for both nations, accumulating a vast stockpile of these securities. By doing so, China has not only secured a safe investment, but also gained considerable influence over the U.S. economy. This buying spree was driven by China's economic engine, its massive export-oriented manufacturing sector. The relentless production and export of goods have fueled China's economic growth, creating a surplus of foreign currency. As China sold goods to the United States and the rest of the world, it amassed trillions of dollars in foreign exchange reserves. These reserves are a testament to China's trade surplus and economic prowess. These reserves needed a safe and liquid investment, and U.S. Treasury bonds fit the bill perfectly. The bonds are backed by the full faith and credit of the U.S. government, making them a reliable choice. They provided a relatively safe and stable return on investment. This stability is crucial for a country like China, which seeks to preserve the value of its vast reserves. China's purchases of U.S. debt also helped to keep the value of the U.S. dollar high, which in turn made Chinese exports cheaper and more competitive in the global market. This exchange rate dynamic has been a key factor in China's export strategy, which in turn made Chinese exports cheaper and more competitive in the global market. The affordability of Chinese goods has allowed them to dominate various sectors from electronics to textiles. This mutually beneficial relationship between the two economic giants seemed to work well for a while. Both countries reaped the rewards of this financial interdependence, fostering a complex but symbiotic relationship. China found a safe haven for its reserves, ensuring that its wealth was protected and could be used to support its economic ambitions. And the United States benefited from low borrowing costs, which allowed it to fund various initiatives and maintain economic stability. allowing it to finance its spending. This financial arrangement has been a cornerstone of the economic policies of both nations, highlighting the interconnected nature of the global economy. In recent times, however, China has gradually reduced its holdings of U.S. debt. This shift in strategy is driven by a complex interplay of economic and geopolitical factors, signaling a potential change in the global financial landscape. One factor is China's desire to diversify its foreign exchange reserves and reduce its dependence on the U.S. dollar. The Chinese government has been actively seeking alternative investment options, such as gold and other currencies, to spread its risk and reduce its vulnerability to fluctuations in the U.S. dollar. Furthermore, China's own economic growth has slowed, leading to a decrease in its trade surplus and consequently, a smaller inflow of U.S. dollars. This slowdown has reduced the need for China to accumulate more U.S. debt. As China's domestic economy matures, it is looking for new avenues for investment and growth. China's ambitious Belt and Road Initiative, BRI, is another crucial factor driving its reduced appetite for U.S. debt. This massive infrastructure project aims to connect Asia, Europe, and Africa through a network of roads, railways, ports, and other infrastructure projects. The BRI requires colossal investments, estimated to be in the trillions of dollars. To fund this ambitious project, China has been redirecting some of its capital away from U.S. Treasury bonds and towards BRI projects. This shift in investment strategy is part of China's long-term plan to enhance its global influence and secure access to crucial resources and markets. Section 5. Geopolitical tensions. Debt as a bargaining chip. The escalating geopolitical rivalry between China and the United States is another factor influencing China's stance on U.S. debt. Some analysts believe that China might use its holdings of U.S. debt as leverage in trade or political disputes. By reducing its exposure to U.S. debt, China may be aiming to reduce its vulnerability in any potential economic or financial conflict with the United States. This strategic move could be seen as a way for China to gain a stronger footing in negotiations and protect its interests in the face of growing tensions. Section 6. Going for gold, diversifying away from the dollar. China has been steadily increasing its gold reserves in recent years, further diversifying its foreign exchange holdings, and reducing its reliance on the United States dollar. Gold is seen as a safe haven asset, particularly during times of economic uncertainty or geopolitical turmoil. By increasing its gold reserves, China aims to enhance the stability and security of its foreign exchange portfolio. This move is also seen by some as a way for China to challenge the dominance of the United States dollar in the global financial system and promote the internationalization of its own currency, the yuan. Section 7. The fallout. What happens if China stops buying? If China were to completely halt its purchases of United States debt, the consequences could be significant, potentially impacting interest rates, the value of the United States dollar, and the overall stability of the global financial system. China is one of the largest foreign holders of U.S. Treasury bonds, and its actions in the bond market can have far-reaching effects. The interconnectedness of global economies means that such a move would not only affect the United States, but also have ripple effects across the world. The most immediate impact would likely be a decrease in demand for United States Treasury bonds, potentially leading to higher interest rates. Higher interest rates could make borrowing more expensive for consumers and businesses, slowing down economic activity. This could also lead to increased volatility in financial markets as investors react to the changing economic landscape. Higher borrowing costs for the United States government could translate into slower economic growth and increased pressure on the federal budget. The government might have to allocate more resources to service its debt, leaving less available for other critical areas such as infrastructure, education, and healthcare. A decline in demand for United States debt could also lead to a weaker United States dollar. A weaker dollar can have mixed effects. While it might benefit exporters by making American goods cheaper abroad, it can also increase the cost of imports. This could make imports more expensive for American consumers and businesses, potentially fueling inflation. Higher inflation can erode purchasing power and lead to higher costs of living, affecting everyday Americans. A weaker dollar could also make it more challenging for the United States to attract foreign investment, further impacting economic growth. foreign investors might seek more stable or lucrative opportunities elsewhere, leading to reduced capital inflows and potentially stifling innovation and expansion in various sectors of the economy. Section 8. A shaken global system, uncertainty and volatility. The impact of China's reduced appetite for United States debt extends beyond the United States. It injects uncertainty and volatility into the global financial system. The United States dollar has long been the world's reserve currency, playing a pivotal role in international trade and finance. China's move away from United States debt could potentially undermine the dollar's dominance, leading to a multipolar currency system. This shift could have far-reaching consequences for global trade, investment, and financial stability. It remains to be seen how smoothly such a transition would occur and what new challenges and opportunities it might present. Section 9. A new world order shifting power dynamics. China's evolving stance on United States debt is a symptom of a broader shift in global power dynamics. As China's economic and geopolitical influence grows, it is seeking a greater role in shaping the international order. This includes challenging the established norms and institutions that have governed the global system for decades. The implications of this power shift are far-reaching and uncertain. It could lead to a more multipolar world with multiple centers of power, or it could result in increased competition and conflict. The outcome will depend on how China chooses to wield its growing influence and how other countries respond to its rise.